Welcome to SilverOak's quarterly webinar. My name is Shannon King, and I am President, Partner, and Chief Compliance Officer of SilverOak. With me today is Jonathan Charlo, also a partner of SilverOak, as well as our lead analyst. And Jonathan, are you with us?
I am.
Excellent. Well, for those in the audience attending, we are still under our COVID procedures. So Jonathan and I are in two separate locations. Nonetheless, we'll try and make this as interactive as possible. So today's webinar is scheduled to last approximately 45 to 60 minutes. A copy of it, as usual, is always going to be posted after the webinar. It will be posted to our website. If you have any questions throughout today's webinar, please feel free to contact your SilverOak advisor after the session. If you're not working with a SilverOak advisor, you can contact me directly at 952-896-5701. And of course, I want to thank Jonathan and John and the rest of the SilverOak team for making today's webinar possible. And actually, I want to send out a special thanks to our entire team for their hard work and dedication throughout 2020. COVID certainly brought new challenges most of us never thought possible, yet we as an organization were able to continue providing the exceptional service our clients have come to expect. And I also want to thank our clients for placing their trust in SilverOak, especially during such a challenging time as we've experienced a once in a century global pandemic. I'm probably confident in speaking for everyone on today's webinar. We hope 2021 brings an end to this pandemic and a return to some normalcy. Frankly, Jonathan, it'll be nice for us to be able to sit in the same room and actually conduct this webinar at some point together.
I agree. I definitely agree.
For compliance purposes, I must note that we will be discussing the overall markets and the economy during this webinar. In doing so, we will be providing our interpretations and perspectives. You should not rely upon this information as fact when making any investment decisions. We will not be discussing specific SilverOak portfolio performance, as each of our client portfolios are customized. Nonetheless, each client should have received by now their customized performance reports. If you have any specific questions, please reach out to your SilverOak advisor if he or she has not already contacted you. And of course, the last disclaimer, past performance is no guarantee of future success. So let's look at the agenda, and we have a full one today. We'll start as usual with the economic data for the quarter, transition into market data. We'll give you a brief outlook on what we think will be happening over the next couple of months or throughout the rest of this year. We'll talk a little bit about current market trends, give you a very short update on SilverOak happenings. We are in a new year, which, by the way, Happy New Year to everyone. With that, we'll talk about some planning tips to keep in mind. We'll touch a little bit on the recent tax updates that have been passed and really close out today's discussion with a very brief overview of the new administration stimulus package. And of course, I encourage everyone to reach out to their advisors if you have questions on any of these topics. But before we really get into the most recent data, I think it's worthwhile to take a look back at the first quarter of 2020. So the next couple of slides are going to be slides that we actually pulled right off of the April 2020 webinar. So if you looked on our website at that webinar, you would see these next few slides. Where were we at that point? Well, as you can see on the market dashboard, the markets were dropping in that first quarter of 2020 2020, as well as the economic data was dropping. The economic scoreboard, with the exception of fiscal policy, monetary policy, interest rates, and commodity prices, everything else shown on the scoreboard was either neutral or negative, and most of the sentiment was to the downside. So that first quarter, as you recall, was a very difficult quarter with COVID just really hitting the United States and the world. Consumer spending fell globally like a rock. Really, the only thing that was up were jobless claims and unemployment. GDP was expected to be hit significantly. And Jonathan, why don't you touch on that?
Yeah, so this was really the viewpoint of how bad things could be. And when we look at it, Morgan Stanley was definitely the most negative in the second quarter. And, kind of, in fact, they were pretty close, but they weren't even negative enough because actually we did see a decline of 31.4%. So they were pretty close. But then if we look at the third quarter, they were expecting a bounce just a little bit less than the decline. And in fact, though, they were a bit conservative as growth boomeranged up 33.1%. But as we know with negative numbers, just because it was up 33%, it was actually still down. And in fact, you would need a 45% increase to get back to even when you have a 31% decline. And so we've definitely seen a bounce since then, but even today we're still down from where we were at the beginning of the year.
Yeah, and again, this is data right from our April 2020 webinar. And if we go back and look at that webinar, everything that we've discussed, all very negative. In addition, we were expecting a big contraction in earnings after that first quarter of 2020. As a result, we had provided information on how the Federal Reserve was responding to the economic data. And at that time in April, we said the Federal Reserve was going all in. And we actually have 3 slides from that April 2020 webinar summarizing the actions the Federal Reserve had taken at that point. And that was literally between February 28th and mid-April when we gave the webinar. So 3 full pages of different actions that the Federal Reserve had taken up to that point. And obviously since then, there have been quite a few other actions the Federal Reserve and Congress has taken. And at that point in April of 2020, we even indicated that this could be reckoning a new era of central banking policy. Now, there are good reasons that we entered into this potentially new era, but we did it at a magnitude we've never seen. So Jonathan, do you want to touch on the magnitude of relief we had seen even as of April of 2020?
Yeah, as a matter of fact, what we can see on this slide is just the how fast the stimulus came. So you see on the left side that the total in terms of stimulus at that point was higher than what we saw after the Great Recession, but it happened extremely quickly. And that was
the blue is the Great Recession,
right,
over many days, hundreds of days. The red is just this most recent COVID fiscal policy, very few days and a big number. Is that true?
Yeah, no, absolutely. And then what I would add on top of that is that, of course, we've even had one more stimulus package approved, and then we'll talk about it today, but President Biden is proposing another large round of stimulus.
Yeah, I think the number now is it not up to 4 trillion. So the CARES Act got us up to about 2.2 trillion. I think the total stimulus so far is around 4, maybe slightly more than 4 trillion, maybe 5 trillion.
Yeah, that's correct.
Wow. Well, of course, that's unprecedented stimulus, both fiscal and monetary. But there was a reason, and good reason. I mean, we were faced with really what could have been the next Great Recession or Great Depression even. And I think Jerome Powell, the head of the Federal Reserve, explained it best when he said they were really just trying to build a bridge over this very deep chasm that was created as a result of COVID. And frankly, thus far, looking back, it seems like it's worked because we are on the road to an economic recovery. If we look at our market dashboard, this is the most recent data, we can see that there are shifts expected here in this first quarter from more neutral positions to more positive positions. As a matter of fact, if we look across all 4 of the major segments of the market dashboard after the first quarter of this year, we're projecting all of them to be in positive territory with the exception of valuations, and we're going to talk about valuations a little bit later today. So that's all very positive. You can see here the market dashboard. We've got a nice bounce off the bottom. As a matter of fact, the current composite is slightly above an important threshold, kind of pushing it up into more positive territory. Now, the 6-month trailing is not yet above its important threshold, but it's getting very, very close. So again, all positive signs that we're getting from the economy. If we look at the factors, again, shifting from what we saw in April of 2020, where there was a lot of negative sentiment, we're starting to see more positive sentiment here. Although admittedly, I don't want to get too optimistic, there are still a number of different factors that are falling in the neutral and negative categories, but at least the trend looks to be more positive. And of course, GDP has started to recover. As Jonathan already alluded to, we got a nice bounce in the third quarter, and it looks like that trend is continuing, as is the trend for improving employment. Now, Jonathan, do you want to speak to the fact that the employment numbers, although improving, are maybe not quite as consistent as we had hoped because of some issues related to COVID?
Yes, absolutely. So we did see non-farm payrolls in December unexpectedly declined about 140,000 jobs. Now, the viewpoint is that the more recent surge in COVID cases did cause some states to kind of go back into partial lockdown. Now, we saw this in Minnesota, and so obviously that had an impact on jobs. And if we look on the right-hand side of the slide, you'll see kind of to the far left that the leisure and hospitality industry, and really the most affected industries, have recovered some of the jobs lost, but there's still a long ways to go. And that's going to be uneven as we go through this year, but likely over the course of the year, we should be in the right trend.
Right. And I think that's really the key, that things are beginning to recover, and we're seeing it in other areas too. Manufacturing has certainly recovered off of its lows. Now, we did see a slight lull in the small business recovery. Hopefully, some of the more recent stimulus is going to help in that area, but that did bounce off the bottom. We're not seeing it continue in the trend that we maybe would hope. And the consumer rebound maybe is starting to flatten a little bit as well. Although, having said that, households are really in good shape. Now, I say that a little bit cautiously because I understand if you're one of the 10 or 11 million folks out of a job, your household probably doesn't look quite as financially stable. But overall, household net worth and excess personal savings is trending to the positive. So Jonathan, do you want to touch a little bit more on that?
Sure. So on the left side of the slide, we're looking at household net worth. And if you look in the middle, you can see the dip back during the Great Recession. But if you look on the kind of far right, you'll see a dip that occurred last year, but it really was very short lived. And then we've seen it bounce. And in fact, household net worth is at all-time highs. And of course, we'll talk about performance later, but the recovery in the stock market had a lot to do with that. Now on the right side, we're showing that there is in aggregate 1.4 trillion in excess personal savings that was generated last year. Now a good bit of it, not surprising, is a decline in spending. As people were at home working remotely, people just were not spending as much. Now the other side of that was there was a rise in income. And again, as you mentioned, that was probably there was probably some income inequality issues, but in aggregate, there was an increase in national income, and that's really reflected here.
Right. Yeah, and I think that's a really excellent point. These slides are not getting to the inequality component. There's no question that there's been this widening of the wealth gap, and that is something that I think Congress is going to be looking at. And if you listen to Janet Yellen's testimony to Congress in her hearing on Tuesday, she even mentioned as the new Treasury Secretary that looking at that wealth gap would be something the new administration would be very keen to do. The other thing with regards to the recovery that we wanted to mention is in relation to earnings. We do expect earnings to recover sharply later this year. And that obviously could be good for the stock market and continuation of what we've seen in performance. Which really is a great transition into how the markets performed during the fourth quarter, and really as we're closing out the year's data, how the markets performed for the entire year. So if we look here, for the quarter, the markets were up significantly, double-digit returns, which transitioned into really strong performance for the entire year. Now, a lot of this was due, at least in my opinion, a vast majority of this was due to the strong monetary and fiscal policy that was implemented throughout 2020, which likely resulted in these positive numbers rather than, frankly, seeing negative numbers in front of all of these double digits. As far as the bond market, Jonathan, what did we see happen there?
Well, in the fourth quarter, we saw modest bond returns in the U.S. Global returns were a bit higher. And then on the commodity and REIT side, we did see a nice bounce in the quarter. Now, for the year, what we're seeing is bond returns last year, well, I would say were above average. Now, part of that had to do with interest rates going down for much of the year. But we did definitely see bond returns kind of slow down in the U.S. in the fourth quarter, but a strong year nevertheless. But when we look at commodities and REITs, despite the strong fourth quarter bounce, both of those asset classes did close with negative returns for the year.
Sure. Well, and the other thing that we saw in the fourth quarter that I wanted to highlight here is that we finally saw some rotation in the market from growth more toward value during the fourth quarter, and from large cap more towards small cap in that fourth quarter. That was a transition anticipated to occur at some point, but frankly, we hadn't seen it. And finally, we're starting to see those signs. And a lot of those trends have continued into 2021. Now, of course, still for the year, growth dominated, although small cap was able to eke out a little bit of a benefit over the full year above large cap. Now, looking back to the March lows, frankly, everything has done exceptionally well since those March 2020 lows. Let's touch on international now, Jonathan.
Well, international was up across the board in the fourth quarter. Latin America led the way, up a little more than 35%, but consistent returns. So that was certainly nice to see. Now for the year, still some unevenness. If we look, definitely higher returns in China in the Asia region. I think that has something to do with the fact that economic growth in Asia did improve more quickly. And part of that, I think, was that they've had experience with pandemics in the past. And so they were really able to stop the spread much more early, and so they could recover. And then we look at Latin America being still down quite a bit, and they were more affected. And then when we look kind of to the right into Europe, obviously they were badly affected, and that affected annual returns. Within the bond market, I said that the credit or corporate bonds did outperform in the fourth quarter. And so when we look at those returns, you're going to see to the left side that kind of the higher risk bonds did perform better. So emerging market, high yield or junk bonds, and corporate bonds. And then if we look to the far right, you'll actually see treasury yields, and this would be the 10-year treasury. Those actually did tick up a bit in the fourth quarter, which led to negative returns. But when we look at the annual returns for 2020, it was, as I had mentioned earlier, a fantastic year for bonds, and really the highest returns did come from the right side, which are more treasury oriented. And so we saw the 10-year treasury returns greater than 12%. And that was largely due to interest rates coming down in the year. But even so, on the left side, which are kind of the more risky bonds, they also had a decent year.
So really what I'm hearing, Jonathan, is both equities and bonds did quite well throughout the year, and really the year ended with more broad-based performance. I remember you and I talking, maybe it was in the second quarter of 2020 in that webinar, where most of the performance in the markets, especially the equity markets that is, was coming from a handful of stocks, large cap growth oriented stocks. But the year really ended with a broader base participation in performance, not just a handful of stocks. And it really wasn't just US stocks, international stocks did well, and frankly, bonds closed out the year pretty well also.
Yeah, I think stimulus obviously helped, and I think also in the fourth quarter, getting more visibility on vaccine approvals and a rollout within 2021, which is, just started.
Sure, which really gets us to then our outlook going forward. And from an economic perspective, we do believe the US economy will continue to recover from what is likely to be a brief, but no doubt very sharp contraction, all due to COVID. More stimulus may be coming. We'll talk about that at the very end of today's webinar with the proposal from the new administration. And of course, with monetary policy likely to continue to be very easy and interest rates remaining low. But as you've already alluded to, Jonathan, a lot of this is largely dependent upon COVID and the distribution of vaccines, and even these new strains of the vaccine or excuse me, of COVID, and whether the vaccines really will be effective against the new strains. A lot of what I just said applies to the international economies as well. COVID's going to really drive the recovery. More fiscal support will probably be needed, but they seem to be entering this early cycle of a recovery, and China may be leading the way, particularly as it comes to a recovery in manufacturing. As far as the equity markets are concerned, as Jonathan just alluded to, fiscal and monetary policy is likely to continue to influence asset returns. There's just nothing like having an extra couple $1 trillion in the system. With interest rates on bonds as low as they are, that money has to find a home, and certainly in 2020, that home was in equities. And if we have continued stimulus or relief, if you want to call it that, it's highly possible that we could continue to see asset returns impacted. Of course, earnings were impacted last year to the negative side, but we expect, as we indicated earlier, for there to be a strong rebound in the second half of this year. But everything remains COVID relied upon and COVID dependent. But growth valuations certainly are stretched, and we're going to talk about valuations in a few minutes. We already mentioned the rotation from value, or into value, excuse me, from growth, a rotation more toward international from US, and maybe even more toward small cap from large cap. Let's touch on bonds, though. Where do we think the outlook is for bonds, Jonathan?
Well, bond returns this year are likely to be more modest. And I know, looking back, we said that last year as well.
I was just chuckling because we did say that.
Right, but what I would say is we really mean it this year. Because again, if we do see that economic rebound globally in the second half, then we are likely going to see interest rates kind of in the middle to long-term range start to tick up. Now, the Fed is committed, and I think central banks are committed to keeping short-term rates low. But if we see rates go up, that will definitely put a damper on bond returns. But the other side of that is credits could be an opportunity. And that would be that as the economy continues to improve, we could see the yields on more risky credit come down. But what I would caution you is that that still has a lot of risk. And so for most investors, it probably doesn't pay to take on that risk.
Sure. Okay. So Jonathan, since you mentioned risk, talk to us a little bit about the recent market trends and our perspectives, especially as it relates to valuations. Walk us through that a little bit, because I know a lot of people, as we closed out the year, had double-digit returns in a once-in-a-century global pandemic, of which had the entire world economy shut down for 2 months. We had all this stimulus flood into the markets, propping up the equity returns. There is some concern on valuation. So talk us through that.
Okay. Now, we're showing a valuation a different way than in prior webinars. If you look on the far right and look at that column, you're going to see blue, which would be earnings growth, and then you'll see kind of yield multiples kind of get put in kind of the same area. But generally speaking, under normal conditions, it's earnings growth that really drives returns. If we look to the left side and look at 2019, you'll see that earnings were up modestly during 2019, but we saw the green part, the multiple, basically the valuation of the market expanded, and that really drove the returns. And then if we look at 2020, that also occurred. We saw multiple expansion. And as we mentioned, earnings were down quite a bit last year, but really it was the valuation of the market that drove the returns. And of course, the strong returns in the fourth quarter did increase the valuation in aggregate for the markets, in this case being the S&P 500.
So to put it, kind of in layman's terms, this is kind of speaking to the fact that markets just generally seem to be overvalued, or at least fairly valued, if not overvalued.
Right, and a lot of that has to do, again, with the unprecedented level of stimulus and Fed support that we saw this past year.
Sure. But does that mean everything is overvalued?
No, and in fact, this, let me explain what we're looking at. So basically, this greenish line, squiggly line that you're seeing is really plotting the median S&P valuation, the price earnings ratio. And on average, it's about 16 times. And currently, you'll see it's a little bit elevated at around 21 times. But the shaded gray is showing the dispersion, meaning the high valuation and then the low valuation. And you'll see that that spread is normally around 11. And if we look at it currently, it's almost 22. And so if we look to the far right, you can see that there are many stocks that are trading 30 to 35 times earnings. But the other side of that is there are also a lot of stocks that are trading well below this market multiple, so trading in that 12 to 15 times. So there are still some cheap stocks out there.
And to your point, there looks to be a lot of support both from a monetary and fiscal policy perspective moving forward.
Yeah, and definitely what we saw last year and what we'll likely see this year with the support is that it will still add some fuel to the recovery in the stock market.
So one question that has come up, and I know we received this maybe the last quarter from one of the webinar participants after the session, was some concern with regards to deficits. And we're flooding the markets with all of this stimulus, either from a monetary or fiscal policy perspective. And what impact does that have? And that in and of itself, frankly, could be an entire lecture. I mean, we could spend all day talking about that and debating all of the different pros and cons. But what this chart here is showing is that there's no question deficits globally have significantly increased or gotten worse. The US, third worst. You can see at the far left of this chart, the US is third worst globally as it comes to running deficits, which is expected to have a negative impact on GDP moving forward. Typically, the larger deficits you've run, the lower your GDP, which also gets to the fact that we are beginning to shift more of our allocations to international than we've had in the past. And there's a number of reasons why we're making a shift in our allocations. At the end of 2020, we completed our global optimization project. And really one of the results, Jonathan, out of that, and you're well aware of this since you're also on the investment committee, is that we increased that international exposure pretty much across all of our portfolios, and we'll be implementing that over the next 6 months as we make these adjustments. Now, as we look at international, there's no question that it has underperformed the last decade. And I don't know about you, Jonathan, but I know for the few meetings that I've had so far this year talking about raising international exposure, the common theme or response is, why would we do that international has underperformed for the last decade. And for the most part, that's true. And you can see that on this slide. But there are valid reasons still to believe international can outperform. And as you see here in this chart as well, that even though something may continue as a trend for 4, 5, or even 6 years, doesn't mean that it continues forever as a trend. And valuations internationally, both in emerging markets and in developed markets, are low in many regards, and certainly relative to the US, they are very low. And then there's cyclical performance issues that could help international. Maybe you want to touch on these, Jonathan.
Sure, and this gets back to our discussion how before the fourth quarter, we saw a very narrow market performance. And in fact, in the US, it was being led by tech companies. So if we look at the far left under the on the columns that are above S&P 500, you'll see that 37% of the weighting is in cyclical sectors and 28% are in the technology names, okay? And it was really technology that led the way up through the third quarter. And then when we saw the market broaden in the fourth quarter, that was really when we saw some of these cyclical elements do a bit better. But the interesting thing is when you get outside the US, generally speaking, tech companies really are not as big of the market cap as they are in the US. In fact, if we look at the ACWI ex-US columns, you'll see that they only represent 13%, whereas cyclical sectors represent 56%. So the bottom line, and again, even if we look out to the far right and see South Asia, EM Latin America, those have even higher levels of cyclicality. And so if we're in a year where performance continues to broaden and with virus, vaccines really helping kind of stop the spread of the COVID virus, and we can see the economy reopening, that really will help on the international side, and we could see better performance really from this trend.
And then there's other reasons that we're seeing some optimism finally in international markets, including what you're showing here with the US dollar falling.
Yeah, absolutely. So this is really plotting the US dollar index over time. And so you'll see that in the 90s, it went up quite a bit. And then from the period of kind of 01 to 07, it went down kind of like a rock. And incidentally, that was the period where we did see international outperform. And then when we kind of look in 2013 and beyond, you'll see that the dollar kind of made a stair step up. And that coincidentally is also when we started to see international underperform, US. Now, I think part of that also had to do with, technology companies in the US doing better from a performance standpoint. But here we're sitting at the end of the year with the potential of the US dollar, falling. Will it get back to 13 levels? We don't know, but if it does, it would be a positive contributor to international outperformance.
And then how about the just demographics of the world? How's that driving or expected to drive international performance?
Well, demographics, I think, is going to be a big issue going forward. Now, many people are aware, certainly, that China has had a growing middle class, and that's really been fueling their economy. But if you look on the far left, you're going to see that India right now is nowhere close to where China is. So as a percentage of their total population, the middle class represents 17%, versus 38% in China. But that's going to grow to almost 80% over the next 10 years. And even when we look at China, that's going to double. So we're going to be at a point, 10, 15 years from now, where the middle class within these countries will be larger than in the Western developed world. And so from that standpoint, that will be an area of growth in the world economy. And so from that standpoint, if you don't own international, you are actually kind of betting against this. And so from a diversification standpoint, it makes sense to have some international holdings in your portfolio.
Well, excellent discussion there on that, Jonathan. I appreciate the extra details. Let's transition now into SilverOak updates, and we'll go through these relatively quickly so we can get on to the tax updates and New Year planning tips, as well as Biden's stimulus proposal. But for SilverOak updates, our IQs, our investment quality scoring system, we did add 2 positions to what we refer to as our watch list closed. That means that we're monitoring them more closely, and in addition to monitoring them, we're no longer adding new dollars. We're not selling out of the positions, but we are no longer adding new dollars in kind of anticipation of further due diligence that's being completed on those positions. One was, if I recall, a global bond position, and the other one was a large cap international growth position that was added to the watch list closed. I already mentioned we completed our global optimization project, and we'll be implementing those new allocations over the next several months. We released 2 different white papers during the quarter, a behavioral finance and a residency checklist. Those can both be found on our website. Real exciting news, we are in the process of implementing a new trading software. As a matter of fact, I just got off a webinar with regards to that right prior to joining this webinar. And as we mentioned at the very beginning, we are continuing to work under our business continuity plan, but we do have a few more team members coming into the office, at least periodically. So hopefully we get to some level of normalcy later in the year as the vaccine gets rolled out. Jonathan, can you take us real quickly through just a high-level review of the new year planning tips?
Absolutely, Shannon. So most importantly, let's think about risk tolerance. The markets are up, and so certainly you don't want to adjust your allocation as a result of the markets being up so strongly. But the other side of it is that last year, obviously in that late February to March period, the markets were down quite a bit. And so you don't necessarily want to adjust your portfolios based on markets being down, but you do want to really kind of assess it on a bigger picture just to make sure that you're still comfortable with your allocation and it matches your personal risk tolerance. Looking at other factors, remember to file your taxes this year. In terms of if you have assets greater than $10,000, you'll want to report your foreign bank accounts. And now's a great time to start planning for 2021 taxes. Also, it's also a good time to think about your 2020 spending. Now, of course, we mentioned last year that with the economy closed, savings were up. But you'll kind of want to look at maybe what changes you made that you like or things that you miss. But that'll be very important to think about. You want to utilize your HSAs for long-term investments as they are tax advantage. Review your Social Security statement online. Review your estate documents. Confirm your beneficiary designations. Rebalance your other investment accounts. So as you mentioned, we'll be looking at our allocations, but you'll want to look at your other retirement accounts as well. And then ensure you have proper insurance coverage.
And I think we're closing out on the last 2 items here.
Yeah, and so of course this is a good thing to do once a year, but get a copy of your credit report. And if you haven't done so, go ahead and freeze your credit. It's actually very easy to do, and you can manage that process online and in fact on your phone.
Well, and this last year, it's been especially important to have your credit frozen. I don't recall ever in my career having fraudulent unemployment claims made. But we had a number of clients impacted directly, and I've heard from other advisors, they also experienced this, where clients were calling up and saying, hey, I just got notice that there was a fraudulent unemployment claim made on my behalf. It kind of sickens me to think people take advantage of these circumstances, but there's no question there are people out there that prey upon these types of what they consider to be opportunities. So freezing your credit, I couldn't encourage more. So let's get into the tax updates. And there were a flurry of different updates through legislation last year. I'm not going to go into each of the details on these. These are probably the ones we've listed, those that impact individual filers the most. Of course, everybody's well aware of the $600 refundable tax credit. That's the one that there's new discussion as to whether they want to raise it to $2,000. So give everybody an extra $1,400. That's part of the Biden plan. The $250 educator expense, a $300 deduction for cash donations to qualified organizations if you're filing a standard standard deduction on your tax return. There's a number of these here that you can look through. May or may not impact you directly, but we thought that we would bring them to your attention nonetheless. The one I really want to spend the time on is this one here. The 2020 1099-Rs for QCDs and RMD reversals. So I know there's a lot of acronyms there, but remember, a 1099-R is just essentially like a W-2. It just reports distributions, in this case, out of individual retirement accounts. So a 1099-R just reports these retirement distributions. So let's start with a QCD. What is a QCD, Shannon? Well, a QCD is a qualified charitable distribution. It's a distribution from your IRA directly to a charitable organization. Since QCDs have been allowed over the last couple of years, the 1099-R has not been updated to account for them. It's a weird quirk. I don't know why the IRS has not updated the 1099s. But a QCD, a qualified charitable distribution from an IRA directly to a charity, when you're 70 and a half or older, so it's a required minimum distribution, that is not taxable. But there's nowhere on the 1099-R that would indicate that it's not taxable. So you as a taxpayer have to keep track of this. And you have to remember when you're filing your return, even though you got a 1099-R and that needs to be reported on the 1040, it's not reported as taxable income on the 1040. And the same is true for an RMD reversal. So last year, an RMD stands for a required minimum distribution. So last year, a lot of folks take their required minimum distributions early in the year. But then the CARES Act was passed. And part of the CARES Act said, hey, you don't have to take your required minimum distribution this year. Well, for clients who had already taken it, we were able to reverse it. But because that distribution occurred, even though it was reversed later, a 1099-R is being issued, and that 1099-R does not show that the distribution was later reversed. So if you don't pay attention, you don't monitor it, you would otherwise potentially report that as taxable income, which would be problematic. We're actually putting together communications and sending communications out to all of our clients impacted by this. And of course, those clients that we're doing their tax returns for, we're well aware of it. It's something though that everyone, I think, who at least is 70 and a half and taking either QCDs or RMDs should be aware of. And then there's other year-end stimulus package items, the 11-week extension of unemployment, expanded business credits, the stimulus package at the end of the year funded the government through September of 2021. So with that, let's just briefly, Jonathan, touch on Biden's proposed stimulus package. So maybe here, just walk us through like the biggest picture review of what he has in a stimulus package.
Well, certainly you kind of mentioned this before, but the proposal would be there would be an additional 1,400 tax credit. So putting the two together would be 2,000. You know, another big one is that the unemployment benefit would be $400 rather than the $300 that was passed, and that would extend benefits beyond the 11 weeks, but through September of this year. Rental assistance, of course, it would also extend the eviction moratorium through September 21st, expanded child care and child tax credits that you mentioned, and subsidized health insurance premiums for those who lost work. And then additionally, $50 billion in grants and loans to small business owners. This is a big one. This was a big bone of contention through the different levels of negotiation, but it would be $350 billion given to state and local governments for workers, the vaccine distribution, schools, getting schools back up and running. So it's far less than some hoped, but it definitely is a number that's very large. And then $20 billion for the national vaccination program. And then kind of finally, this is a big one. It would increase the minimum wage to $15 federally.
And I think, yeah, that is, whether this actually gets passed or not is questionable. If you total everything up, it's $1.9 trillion on top of the 4 to 5 trillion that's already been passed. I think there's some concern that the 900 billion package that got passed at the end of the year hasn't really left the Treasury's coffers yet. And whether we need to throw out another 1.9 trillion when the Treasury is still processing the 900 billion plan that just passed a month or two ago. So, you know, as with anything, especially when it deals with taxpayer money and politics, I'm sure there's going to be the two sides arguing on the various components of what this ultimate package looks like and whether it ends up at 1.9 trillion or 1 trillion or 3 trillion. I guess we'll have to wait to see. But that does bring up the fact that I want to end today's discussion with a reminder. And the reminder gets to my famous Venn diagram. I've been drawing this for 20 plus years. The Venn diagram starts with politics, then it goes into the economy, and lastly, the markets. And undoubtedly, there is some overlap in each of these components: politics, economy, and markets. But I want to be very clear that these do not set on top of each other. There's not perfect correlation within these three components. And it's just always a nice reminder that as an investor, you need to be making investment decisions within the realm of the markets and market data. And frankly, your own personal risk profile, your own personal objectives, short-term and long-term. Just don't let politics overly influence those market decisions that you're making. And frankly, don't let the economy overly influence those market decisions. 2020 was a prime example of, if you just looked at the economic data, and we started this webinar with the economic data after the first quarter of 2020. And based on that, frankly, you probably would have sold everything out of the markets and went to cash. And we had some clients wanting to do that. And we certainly had clients shift a little bit more conservatively, which may have been very prudent for them. But don't let the economy overly influence those market decisions you're making, because again, 2020 ended double digit across the board, something nobody would have anticipated as we went into this COVID-induced recession. And politics, I can give you just as many examples with regards to allowing politics to overly influence your market decisions, only for that to be the wrong course of action. So keep this in mind as we're transitioning administrations, as we're transitioning into the new year, and as hopefully we transition into some more normalcy from what was a very COVID-oriented year of 2020. With that, we encourage additional questions. Again, reach out to your SilverOak advisor. If you have topics for future webinars, I highly encourage you to reach out to us with those as well. We've tried to incorporate into today's webinar some topics that we received after past webinars. If you're not working with a SilverOak advisor, feel free to reach out to me directly at 952-896-5701. Otherwise, again, we want to thank you for your time today, and Happy New Year.